So welcome again, children. Now this time for some of the important topics for the papers that are coming up, specifically the amendments. So what I'm going to do is I'm going to record all the amendments that are important, all the case laws that are important, and questions from RTP. Now, while it is important to know that the questions in the paper may not directly come from here, but I can guarantee children from the amendments and from the case laws, you can expect anywhere between 20 to 40 marks of the paper. So in a series of a few lectures, I'm going to be recording all the important topics, and these become very important for a simple reason that इन्हीं में से काफी पेपर आएगा. Now the point that you need to understand, children, is that we keep searching for material. We keep looking at a lot of information available, maybe from the teacher's notes, maybe from the internet, maybe from God knows how much data that you all have available to you right now. But ultimately, who's setting the paper? ICAI. And if ICAI is setting the paper, children, remember, ICAI gives you the data. We keep searching for case study. Now, ICAI gives you a case study module. So with me, we are going to go through every case given in the ICAI module and discuss it together. Then there is a ICAI supplementary. This gives you all the amendments, and it also gives you questions on amendments. And I can say with surety that there are certain points that will come from here. I'm not saying the entire question will come, but I'm saying there will be certain points that will come from here. Then of course there is the ICAI RTP. Now the RTP may not directly always give a question. Obviously the questions given in the RTP cannot be there in the question paper. But it gives you a level. It gives you probably intended topics. So what we're going to do is we're going to go chapter wise. And from each chapter, we will first look at the amendments. And of course, in the amendments, there are circulars recent and recent notifications that ICAI wants you all to know. So we're going to look at chapter wise amendments. Then we're going to look at circulars and notifications applicable. Then chapter wise case study and questions from the RTP in the end to complete one topic. Now the topic we are going to look at today, so you should keep these ready with you. I will help you underline, I will help you mark, and maybe don't get scared by the size of that supplementary module. We are not going to read every line of it. We're going to look at the gist and we're going to underline the topics. Trust me, and since you've been listening to me, you will have some faith in me that the paper will be covered from it. So children, today's topic we're going to look at is deductions. We all know that deductions is a topic which essentially is not a very important topic for the CA final paper. Generally, we don't cover it. There is so much of data to cover. But because there are a lot of amendments made by Finance Act 15, we're going to go through all of these. Now the notes are with you. In the notes, I have given you a summarized chart for the deductions as well as some of the detailed annexures as well. I'm going to be taking you through those deductions here with me. All I require is your attention, listen and absorb. And then of course, as I said, we will do the questions from the RTP. Now deductions are divided into two parts. One is investment based. And the other, of course, is profit based. Investment based will be generally between 80C to we have 80 GGC, and these are covered by 80 IA to, of course, ATU. ATU we can always get here. There is no investment, but then again, ATU will get here. So we're going to look at first the investment based. A few rules. Who claims the deduction? Now, from IPCC, you will remember a bit of what ATC was. So ATC, we're going to do them in groups. So if you look at this chart, well, on the first look, this chart gives you the summary of all the deductions and the provisions of it. I'm going to take you through them, but we'll divide them into groups, beta. One is a group of ADC, CCC, CCD. The other is a group of DDD, DDB. The third group is for donations, and the fourth group over here as a separate category. So we will go through the groups slowly. Let's start with the first group that I'm going to teach you. So deductions are going to be grouped together in four main groups. For us, there is ATC, there is ATCCC, there is ATCCD. But before we start with these, in ATC there are small investments, like you have life insurance premium. Now if you pay a life insurance premium, you get a deduction of ATC. What if I forget to claim it in the return? And this point is important. What if I don't claim it in the return? I have proof that I have made the investment, but I forgot to claim it in the return. Can I file a revised return to claim it? Is the assessing officer under an obligation to allow it to me? Tomorrow, if my case is taken up for scrutiny and then I realize, oops, I forgot to claim it, can I then claim it at that stage? So, when you open your notes, you will see that this point is given under ATA, and this point you will mark as important. ATA says, where the assessee fails to claim a deduction in a return of income either under section 10AA, which is for SEZ units, or chapter 6A, which is ATC to ATU, then no deduction will be allowed to him anywhere. So one thing is very clear, you have to claim it. If you don't claim it, there is no obligation on the part of the AO to allow you. Thus, such a claim cannot be made under section 154 or before the CIT appeals and ITAT. Thus, the aforesaid deductions can only be claimed in the return or revised return, but can never be claimed anywhere else. So what you need to remember is you will need to claim it, and if you forget to claim it, you cannot claim it later. He says deductions under section 10AA or 80IA, IP, IC, ID, IE cannot be claimed where return is not filed before the due date. That means to claim these deductions, your return must be filed before the due date under section 139(1). And in case you've forgotten to claim it in that return, you can then claim it by filing a revised return. But you cannot claim it before by filing a rectification application or before the CIT appeals or the ITAT. So this point you will mark as important. Right, so the first group we say is ATC, which is small investments. ATCCC is contribution to a pension fund with insurance companies. So if you want to cater for your old age and you want to make sure that you're going to receive pension after say 15 years, 10 years, you can put some money now. Money put over here will be eligible for a deduction. Then ATCCD talks about the new pension trust. Now the new pension trust is a government-based pension scheme. We're going to talk about it in a little while. But we have to look at the maximum limits. There is no, as I said, everything has a rider to it. Everything has conditions to it. Now I can't say if my GTI is, let's say, 80 lakhs and I make an investment for 80 lakhs and I say I claim all of them as a deduction and my total income becomes nil. That is not possible. So there will be restrictions on the deduction. The second important point that we need to remember is that deductions of ATC to ATU cannot exceed GTI. So if GTI is 20 lakhs, the deductions of ATC to ATU cannot be more than GTI. You can't have a negative total income. So if your deductions are amounting to 21 lakhs, they will be restricted to 20 lakhs. and your total income will be nil. So 80A of the Income Tax Act restricts the deductions to the amount of GTI. Then we've discussed this over the course. In the chapter of capital gains, we discussed that special incomes, specifically long-term capital gains, short-term capital gains under section 111A. Then you have income from winnings from lotteries, etc. And of course, you have chapter 12 and chapter 12A of the non-residents, certain incomes taxable at special rates, where the income has a rate of tax. We all know long-term capital gains is taxable at 20%, short-term under 111A, which is where STT has been levied, and lottery is taxable at 30%. On these incomes, no deductions are generally allowed. No deductions. So, for example, if in this 20 lakhs, I say long-term capital gains is 12 lakhs, then deductions of ATC to ATU will have to be limited to 8 lakhs. They cannot be more than the income against which such deductions are allowed, and these incomes will not be covered. Therefore, against these incomes, you cannot claim your deductions under ATC to ATU. Now, going back again, what are the maximum limits? So, the maximum limit of ATC now rests at 1,50,000. ATCC also rests at 1,50,000. Now, ATCCD has three parts to it now. There is an ATCCD subsection 1, which is for employees' contribution, and you will need to remember these sections, to new pension scheme or new pension trust. There is ATCCD 2 that talks about employers' contribution to new pension scheme, and of course, what has been added by Finance Act 15 is ATCCD 1B, which again talks about employees' contribution to new pension scheme. Now, let me first write down the limits for you, then we'll do them in detail. Now, the limit over here for this is 10% of salary. And salary over here will include basic pay plus DA if it enters. And I'm kind of expecting a question on this, maybe in the paper. It is possible that there is a question on this over there. Now, on these three, there is another limit of ATCCE, which again restricts the total of these three to 1,50,000. Over and above that, the employer's contribution is subject to a maximum of 10% of salary. And of course, there is basic pay plus DA, only the part which enters. And there is a new deduction of up to 50,000 under ATCCD 1B. Now, picking one at a time, let's start with ATC. What do you get ATC for? I'm going to divide it into three parts. We're going to look at the first part, your life and that of your relatives. So you can take an insurance and pay a premium. Now, let's also go and check a few more conditions. One condition I said that you cannot get deductions from special incomes. Second condition, deductions are allowed on paid basis. We are looking at ATC to ATGGC are all allowed on paid basis. There is no due basis. Over the course of the Act, we learned under the head house property, interest is allowed on due basis. Under business and profession, you have this method of accounting. But under business or profession, we also learned that there is a 43B, which allows you a deduction in the year of expenditure if you pay the money before the due date of return of that year. But that was under business and profession. Now, paid over here means between the previous year, end of the previous year. So, if you paid it during this period, only then will you get a deduction. And the word is paid. The third is paid mode of payment. Mode of payment. Now in the chapter of business and profession, I covered this, but we will just go through it once more. The mode of payment, if you remember, there was a 40A3 under business head that talked about an account paycheck. And if any payment was exceeding 20,000, and it had to be in a mode which was account paycheck. And of course, there was Rule 6DD giving us exceptions for the same. Now, of course, you will tell me 40A3 is not applicable to deductions because 40A3 was only applicable to expenditure covered under business head. So can I say, for example, pay my insurance premium in cash and still get a deduction? Does 40A3 restrict it? So one thing is very clear, 40A3 does not restrict it. So we say there are no restrictions. You can make the payment in cash. However, and there is always a however, there are certain sections that carry a rider. Now one of the sections that carries is ATD. And we will cover all of this. ATD, which is medical insurance. Now for medical insurance, you need to make a payment in a mode other than cash. Now the wordings of ATD and 40A3 are very different. 40A3 talked about by account paycheck. So for 40A3, if I made a payment by self-check, by bearer check, or cross-check, then 40A3 did not allow all three. But when I look at in a mode other than cash, then of course cash is not allowed, which includes self-check is not allowed. But there is no restriction on making the payments by bearer or cross-check. So bearer or cross-check, technically, if you make a payment, are allowed modes of payment while taking the deductions under ATC to ATD. Then under ATD, we will talk about something called preventive health checkup. And I will come to that when we reach there. Preventive health checkup, which is now everybody wants to get a checkup, the blood test done. Do I have a problem if I'm going to die? So all those preventive health checkups, you can make a payment in cash. That is allowed. In AT, GGA and ATG, if the payment exceeds 10,000, then it has to be made in a mode other than cash. And for political parties in GGB and GGC, the payment has to be made no matter what amount it is in a mode other than cash. Apart from these three, there is no criteria for the mode of payment under the chapter on deductions. Now that I have clarified, there is a question when you go through the chapter, there is a question which is given which will clear this particular point. So we come back. Now we're looking at ATC. We said ATC is premium. Now we're talking about life insurance only. And insurance could be for self, spouse and children. Children could be any age. For example, I'm not a minor, nor are you. But if your father takes an insurance for you, the father will get a deduction. Because this section talks about self, spouse, children. It does not say dependent children. Now, in case of life insurance, we need to keep a few things in mind. So we come to life insurance. We have banks, we have HDFC, and we have HDFC insurance as well. But of course, the ownership is common. Now, banks are meant basically for investment, and insurance is essentially as a risk cover. And the government does not want to mix the two. The government gives benefits to insurance sector, but not to the investments in banks. For example, I make a investment in life insurance, I get a deduction of ATC. I earn bonuses or income accrues on it, that is not taxable. I receive money from life insurance, that is also exempt. There is a section 10 subsection 10D that exempts it. So the insurance sector does not tax life insurance, or sorry, the income tax does not tax life insurance. Now let's differentiate between investment and insurance. If I want to make a FD, I deposit maybe 5 lakhs. immediately and I have FD. Now, if I want a life insurance for 5 lakhs, I am not going to put 5 lakhs immediately. We will decide a term. Maybe the insurance is for 10 years. So in the next 10 years, I will pay a premium every year. So maybe in the first, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th, I have equal premium. So I pay 50,000 per annum. By the end of the 10th year, I paid the insurance company the entire amount of the money I have insured myself for. So we call this sum insured. Now after the 10-year period, maybe there's a cooling 2-year period, and after the 12th year, the insurance company is going to pay me back my 5 lakhs plus of course any bonuses, let's say amounts to a total of 7 lakhs. This is exempt under 1010D. This is allowed as a deduction under 80C, and accrued interest over here, or bonuses as we call them, are not taxable. So if you notice the differences, over here you are investing lump sum, over here you are investing over a period of time. But insurance sectors, a bank feels, HDFC feels, if I get an FD made and the person earns an interest of 2 lakhs over 10 years, this interest will be taxable and maybe in the 30% bracket. So people investing in a bank or making FDs in a bank are wary because there is a tax liability to it. So let's ask them to make a insurance investment. Now we say, okay, we'll take 5 lakhs right now. We call it a one-time insurance policy. So one-time insurance policy, you say, I'm going to take 5 lakhs not in an FD here, but in the insurance. The parent company is only looking at money coming in. Now in the insurance sector, once lump sum money goes in, can we now call it insurance? And if it is, should we give it the benefit? So section 1010D was amended in 2003. Long time back, of course. Now in 2003, we were told that if the policy is taken on or after 143, and this is important, we said policy is taken on or after 1403, then the premium payable in no year must exceed 20% of sum insured. Plus 80C was amended, and the deduction under section 80C is restricted to 20% of sum insured. But in 2012, again the law was amended, 1010D was amended, and we now reduce this 20 to 10%. A similar amendment was made in 80C, which now means the government says the premium should be lower than 20% of the sum insured. So we are basically saying insurance policies are ones where you are contributing little money every year to build up. If you're contributing 20% also, that is too much, he says. So 1403, but we now come to here before 1412. So the premium is now reduced, and if the premium exceeds these percentages, then section 1010D does not exempt the policy receipt. It now makes it taxable. And 80C restricts the deduction to 20, and of course now it becomes 10. So for policy issued on or after 1412. Now the insurance companies felt that by taking a 10% premium, because please understand, if anybody dies in the 4th year, the insurance company does not get the balance money, but they still have to pay the entire 5 lakh rupees. So that's a risk. So if somebody dies midway, insurance companies are not getting the balance money, yet they will have to pay the legal health, the entire 5 lakhs plus any accrued bonuses. I hope you are following what I'm saying. So insurance companies said to cover the risk of a disabled person or for specified diseases like cancer, thalassemia, etc., 10% is too low. So the government now corrects the mistake and says for policies issued on or after 1413 for a disabled person covered by ATU or a person suffering from a specified ailment covered under 80 DDB, we will now take the premium to 15%. So you have a lot of dates and percentages to memorize. So if the policy is on or after 143 but before 1412, the premium should not exceed 20% of the sum insured, and if it does exceed, then the ATC deduction shall be restricted to 20%, and the money received from such a policy, wherever it is, will be subject to tax. Similarly, if the policy is issued on or after 1412, then the percentage goes down to 10%, and if the policy is after 1413 and it is for a person covered under 80U or 80 DDB, then the percentage is 15, else it remains 10. So just to clarify, a few questions we can probably do on this. We say the policy is issued on, let's say, 1411. Now this is before 1412. So the sum insured can be a maximum of 20%. Now the premium payable, if you notice, is 20%, which is within 20% of 1 lakh. But the assessee paid a premium of 30,000 in the first year. He had extra money. Now the deduction will be restricted to 20,000. There is no carry forward of this deduction. Sorry, it has to be paid during the year for which deduction is claimed. So if second year is 1213, the next year deduction will only be 10,000. The next year he's paid 20,000. Now the deduction for ATC is on paid basis. And because the premium payable as per section 1010D in no year exceeded 20%, this is exempt under section 1010D. There is no taxable. If I take the other example on 1411 again we have to look at a maximum of 20%. Now the premium payable drawn is wrong. In 1 year it is exceeding 20%, in the next year it is exceeding 20%. Now the exemption in the year of receipt is not there. Which means whenever the money is received from this policy, it will become taxable. Hope you're understanding what I'm saying. But because the premium paid is within reasonable amount, he will get a deduction of 20,000 per year. Now this amount that becomes taxable, law introduces a section 194DA for TDS. All of this is given in the module. And the TDS is now at the rate of, if the money exceeds 1 lakh rupees, then TDS is deductible at the rate of 2%. And that is only if, of course, 1010D exemption is not available. The money is taxable and it exceeds 1 lakh. So if the money is taxable yet it is below 1 lakh, money is taxable, but there is no TDS over here. Now if I take the policy issued on 1412, now the maximum becomes but at 10% of the sum insured. So if a policy has been drawn like this also, since this exceeds 10% of 1 lakh, which is the sum insured, the benefit of 1010D in the year of receipt is not there. Therefore 194DA TDS will be applicable, of course, only if the maturity amount including bonuses exceeds 1 lakh. The deduction will now be restricted to 10,000 in each of the year. The excess amount will not be allowed as a deduction because the deduction will be restricted to 10% of the sum insured. So we finished the first part of ADC, that is life insurance, and I have taught you everything that there is to know about it. Let's go to the second part. What else do we get a deduction in ADC for? So we say you can invest in a statutory provident fund, employees contribution, in a recognized provident fund, whatever you contributed during the year, in a superannuation fund, and then of course there is public provident fund, which you can do again for yourself, your spouse, your children. Again the limit over there is a maximum in PPF for 1,50,000. Then what you notice over here is unrecognized provident fund contribution is not allowed, but we've talked about this earlier in business. Then the third part is for a residential house property which may be let out, which may be self-occupied, which may be vacant. whatever is the principal repayment of a loan. We know under the head house property, interest component is allowed under 24B. The principal part is allowed under 80C, but the limit over here is 1,50,000. Under house property, there was no limit except for a self-occupied house where the limit was 2 lakhs or 30,000. Under house property, you were getting interest deduction for a commercial shop as well as industrial shed as well as a residential house. But over here, the deduction is only for a residential house. Under house property, you could get a deduction for interest, whether you took a loan from a bank or anyone else. But under 80C, you will get a deduction only if you've taken a loan from a bank or a government or National Housing Bank. You can't get a deduction for the principal portion for a loan taken from a relative or a friend. But you can get the interest deduction under 24B for a loan taken from a friend. Now the comparison between 24B and 80C is given in the notes. So repayment of loan. This of course is from the year in which the house is completed. So if your loan started, let's say earlier, we say your loan started from 1/4/2011 and 11/12, 12/13, 13/14, 14/15, you paid interest and principal, because remember you paid interest as well as principal. Now this pre-completion principal is not going to be allowed in 80C. Yet the pre-completion interest, remember, will be divided by 5 and allowed from the year of completion over a period of 5 years under section 24B. In 80C, for the principal part, you will only get a deduction hereafter once the house is completed, and you will get the principal part of the loan. And of course, the banks will give you a statement at the end of the year. The banks will give you a statement at the end of the year. Okay, here is the amount of principal, here is the amount of interest, and you can claim that deduction. So no pre-completion. Now, 80C also does not say that taking a loan is essential. It's not. Even if you constructed the house with your own funds, that is also allowed. But then again, if you understand, and of course you're in CA final, you will understand that in case of own funds, whatever money you spent before the house was completed is not going to be allowed. In the year of completion, in case there is some money you spent, that will be allowed, and thereafter, of course, there is no money you're spending, so that is not going to be allowed. So we come back. We've covered 3 parts. We've said life insurance, funds, we've talked about a residential house property, and then of course education of children. So 4th is tuition fees. Now the moment I say tuition fees, all of you will start feeling that the fees you pay to us is going to be eligible, but that is absolutely wrong, because this is for full-time education, which is college fees, school fees, university fees in India, full-time education in India. And of course, if you've been a little irresponsible and have more than 2 children, family planning was not your game, it will be restricted to a maximum of 2 children. So tuition fees for full-time education in India, education must be in India, maximum 2 children, you will get the deduction. Now tuition fees means admission fees to school, college, regular tuition fees for classes, but there are at times something called donations given to get a seat in a school. That is not allowed. Capitation fees is also the same. All of this is not allowed as a deduction. So what you need to understand is, if a father is paying money for tuition, say for example school fees, I say 1 lakh a year. Now if 1 lakh a year is not allowed as a deduction, that means it is included in the GTI, because you earned the money, obviously. You spend the money in tuitions or in the school. If you don't get a deduction, it is a part of total income. And if it's a part of total income, you're taxed on it. So if I say a tax of 30%, that means on 1 lakh that you've already spent for your school education of your child, you got no deduction for a minute. It's included in the total income. There's a tax of 30%, so you pay 30,000, which actually means that tuition or that college fees or school fees cost you in effect 1,30,000 instead of 1 lakh. So by giving a deduction over here, we are keeping the education cost low and we are not taxing it by allowing it as a deduction. So that's the first part. The second part we say is relating to National Housing Bank, NSC investments. Then you have infrastructure, company, shares, debentures, and mutual funds. Now, all of these require money. NHB is a refinancing bank. It requires money to finance other banks. So NHB comes up with a lot of schemes. You might want to buy one of those schemes of NHB so that you get interest. Now, by telling you that whatever amount you invest in an NHB scheme, you will get a deduction of ATC, makes it all the more lucrative because you will also get a deduction for the investments, which means you will not be taxed on the same. Yet you are getting your interest. So NHB, NSC, companies which are in infrastructure require money, and the government needs to encourage these people. So the government will approve. So all of these have to be approved schemes. And if these schemes are approved by the government, you will see ads in the paper saying, okay, mutual fund scheme, please buy to avail deduction of ATC, which means they've claimed or have received the approval under ATC. So these are basically modes wherein the government is giving both sides sugarcoating. The person investing is getting a return plus he's getting a deduction. So an investment of 1 lakh reduces the income by 1 lakh. There's a saving of 30,000 of tax, which means the investment is actually costing him 70,000. You have to understand what I just said. If you don't, rewind and listen again. And the company, NHB, mutual funds are getting the money in. So there's circulation in the market because the mutual fund will then be investing the money further. So there is market money circulation, the economy keeps moving. Then of course we come to the C category. We say buy NABARD bonds. Invest in FDs for 5 years in a bank. There are special schemes over there. Or a 5-year FD in a post office. Fixed deposit. And there is of course a senior citizens saving scheme. Now, by getting this, NABARD will keep getting the money. The banks will get money for 5 years. 1,50,000 per year. If everybody starts investing to claim a deduction of ATC, the banks are never short of money. So they always have money to give further loans. And remember, it's a 5-year FD, which means you blocked your money for 5 years. You are happy because you have an FD, which is going to get you interest, yet you've gotten a deduction. Then last, what we've added this year is the Sukanya Samriddhi Girl Scheme. Now this of course is an amendment. It's a scheme started by the government wherein a father or a guardian is providing for the girl child, is making investments, and the interest from such a scheme will also be exempt in the hands of the parent or the guardian. Money received from such a policy will also be exempt, and the money put in a policy will be allowed as a deduction. So all of this will come under 80C. Continuing, we've now looked at the deduction of ADC. Now ADCCC is simple contribution to pension fund. It's again a maximum of 1,50,000. Till last year it was 1 lakh. Now it is 1,50,000. Now let's look at ADCCD, children. First of all, understand a new pension trust is a trust separately incorporated, which is to look after the new pension scheme. Now, who can take a pension policy from new pension trust? An employee, an employer, obviously an employer for an employee, and somebody who is self-employed. For example, I am self-employed. There is no employer who is going to look after me. I have to fend for myself, so I might as well take a pension policy here. Now whatever money I deposit, I will get a deduction subject to a maximum of 10% of my gross total income. In case of employee and employer, employer might also contribute and so must the employee. Now let's have a look. Let's say there is an employee with a basic salary of 5 lakhs. There is a DA that the employee is getting, let's say, which is 20%, and we say 40% enters for calculation of retirement benefits. So he's basically getting 1 lakh more. We say the employer has contributed about 90,000 and the employee contributes about 1,50,000. Can they do that? Yes. Now what do? We say employer. Now in the hands of the employer under the head business and profession, there is a salary being paid, so he gets a deduction of basic pay of 5 lakhs. There is a DA being paid of 1 lakh, but he's also paying 90,000. So this goes under section 37, but the deduction for the contribution of the employer to the new pension scheme of the employee is given under section 36, which is restricted to a maximum of 10% of salary, and this will include basic pay plus DA which enters. So we say 5 lakhs is the basic pay, DA entering is 40,000. Therefore, 5 lakh 40,000 into 10% is equal to 54,000. So as you can see, the employer has paid 90,000, but the deduction allowed to him is only 54,000. So basically, the government is trying to say, we allow you to invest maximum 10% of your employee's salary on his behalf. In the hands of the employee, there is a section 17(1)(8) that says the entire employer's contribution will be added because the employer has paid 90,000 to the employer. So the entire 90,000 becomes the value of services. So that will be added. So we have now 6,90,000 becomes gross salary. There are no deductions. So 6,90,000 becomes net salary. There is no other head of income, we assume. So this becomes gross total income. Now, from this GTI, you're going to get deduction of 80 CCD. The employee's portion is subject to a maximum of 10% of salary. So again, 10% of salary, which basically means it will be restricted to 54,000. And because the employer's contribution has been added to the salary of the employee, it's now kind of that the investment the employer made, which has been added to your salary, is now what the investment you made. So you will also get a deduction. This is 80 CCD1. And for employer's contribution, again 10% of salary, which is 54,000. So essentially, the employee has contributed 2,40,000, but he's going to get a deduction of only 1,08,000. So the balance that he's investing is now being taxed, which makes his investment a little more expensive. So 80 CCD 1B, he says over and above, I give you a deduction of 50,000 up to. So which actually means out of 150, if I claim 50 here, then I'm left with 1 lakh, which will be subject to a maximum of 54,000. So in effect, I will get now 54,000 here, 54,000 here, and another 50,000 here, thereby increasing my deduction and allowing the employee to invest more than 10% of his salary in the pension fund as well. But to absolutely understand the restrictions being placed, we have to now go and understand this. So if I take an example, I say my deductions of ATC are amounting to 90,000. I say my ATCCC is amounting to 20,000. And there is an employee's contribution, like we just said, 1,50,000. There is an employer's contribution, I say 90,000. What we do? Let's first do, if we don't have 1B, what will happen? Now, assuming that, continuing with this example, the employee's salary is 5,40,000, which is basic pay plus DA enters into 10%. So this is going to come to 54,000. Now on this, we get 1,64,000 restricted to 1,50,000, which means even the entire benefit of this is not being given, because there is an overall restriction of 80 CCE, which restricts the three deductions, and three deductions will exclude the employer's contribution. The employer's contribution, again, this will be odd 10%, which will again amount to 54,000. Now, because of this particular section that has been introduced, what we will do now, we will go here back again. So we now say out of this 150 that the employee had contributed, we take 50,000 here. The balance now left eligible is 1 lakh. That we will restrict to 54,000. So I get 54,000 here. Therefore, I get 1,64,000, which will again, of course, be restricted to 1,50,000. Therefore, but I still got an extra. Yes. If, for example, in the same example, we take different figures to help you understand. Assuming, of course, basic pay plus DA enters is 5,40,000. Take that as a part of the example. I said there is no deduction ATC, no reduction ATCCC, only 1,50,000 here and 90,000 here. Now, if this is 1,50,000 here, it will be restricted to 10% of salary again, which means 54,000. This will also be restricted 54,000. So till last year, I would have gotten only 1,08,000. But from this year, he says out of this, claim 50,000 here first. Then subject the balance to the restriction, which will again come to 54,000. So it's in effect, out of 150, he's allowing me another 50,000 here. Though he has a complicated way of doing it, he does not want to increase the limit here, because that will increase the limit of ATC and ATCCC as well. So he gives me an additional ATCCD 1B. That's his way of giving me an additional 50,000. But what if, children, I say the amount contributed by the employee is only 20,000? Well, now 20,000 restricted to 10% will also amount to 20,000 here. I cannot now claim another 20,000 here because there's a total of 20,000 only. So either you claim it under 1B or you take it under CCD 1, you will still get only 20,000. So obviously the deduction will be given once you've invested the money. So that, my dear children, and there are questions given in the RTP, there are questions given in the module work for this. What we've covered is this link, CCD, subject to a maximum of 150. There is 1.5 lakhs, 1.5 lakhs, 10% for employees' contribution, plus 10% of employers' contribution here, and ATCCD 1B, which is a maximum of 50,000. So now let's look at the second category, which is ATD, ATDD, and ATDDB. All three sections for medical care. Now, obviously, medical care is important. So the government feels that whatever expenditure you're making on medical care should be allowable as a deduction, so that you're not taxed on your expenditure on medical care. So we have three sections. Let's just divide them into what they are for. Now, D is for medical insurance premium. DD is for treatment of a dependent of yours, of a dependent who is suffering from a disability. So we have a few words, we have a dependent and disability. ATDDB is for expenditure on treatment of specified ailments. Now there are amendments here which we will talk about. The first and foremost, ATD, the payment should be made in a mode other than cash. Dependent over here will be spouse, children, parents, brothers and sisters. 80DDB is also for treatment of specified ailment of self or dependents. And dependents over here again means spouse, children, parents, brothers, and sisters. So first and foremost, there are three sections we are looking at: 80D, DD, and DDB. Now I'm going to take up the smaller ones first. 80DD and DDB, first of all, you require a certificate from a doctor. Till 2014-15, the certificate could only be valid if it was from a government doctor or a dispensary of the government. Now this has been done away with. From 15-16, you're going to be able to get these deductions if you get a certificate from a specialist. So if you have cancer, specified ailment, you might need it from an oncologist. If you have something in the orthopedics department, then you need a certificate from the orthopedician. So you need it from an expert doctor, specialist doctor, not necessarily working in the government hospital. That is one amendment. Second is, now in 80DD, if there is a person who is maintaining a relative, being these people who are dependent on him, and he is incurring expenditure on treatment, or there is a special policy for disabled people, wherein if you take a policy which is covered by 80DD, tomorrow if I die, then the disabled person will be maintained by that policy. So whatever expenditure on treatment or this or both or anyone, doesn't matter. So 80DD does not look at the actual amount. It just says if the disability is certified. So we said disability is certified, and we now know certified by a specialist. It is more than 40% and less than equal to 80%. So the doctor says your disability is affecting your work capability by more than 40%, less than equal to 80%. Then earlier the deduction was 50,000, which has now been increased to 75,000. If the disability was 80% more than earlier it was, which has now been increased to 1,25,000. Irrespective of the money spent. That means maybe you spent 20,000 on the treatment. Maybe you spent 20 lakhs on the treatment. Doesn't really matter. You're getting a deduction of either this or this, depending upon the percentage of disability, not the amount spent. Then comes 80DDB. Now 80DDB talks about, as I said, expenditure on treatment. Now expenditure on treatment, he says, this is one of those deductions where I believe, well, he's giving you a deduction but not essentially making a difference, because he says amount of expenditure incurred or 40,000, and then he has the audacity of saying whichever is less. Now today in modern medicine, 40,000 is too small a sum for treatments of specified ailments. But then again, he is also bound by running a country which requires tax to be run. So if he raises the exemption limit, the taxes go down. So for the moment, it is expenses or 40,000, whichever is less. But if the treatment is of a senior citizen who is a resident, which means any one of these is a senior citizen and is a resident, then the expenditure goes up to, or the limit goes up to 60,000, or expenditure whichever is less. And from 15-16, he's added very senior citizen resident, 80,000. So the amount of expenditure incurred or 80,000, whichever is less for a very senior citizen. For a senior citizen, expenditure of 60,000, whichever is less. In other cases, expenditure of 40,000. But remember, these additionals are only if the people for whom the expenditure is incurred are residents. Now for medical insurance premium, we need to now, I'm going to try and make it easy for you by dividing it into a particular chart. Now he divides it into two parts. One is self, spouse, but children only if dependent. So the deduction for medical insurance premium, if I'm taking a premium for my son who is still dependent on me, allowed. But when my son starts earning, then will not get a deduction. In life insurance, it was different. Remember, I could get a deduction for a child even if not dependent on me. Then, of course, it's nice to keep your parents healthy and look after them. So, we are now looking at medical insurance premium. So, medical insurance premium. The debate being medical insurance premium is from insurance companies. So I can take a policy, whatever premium I pay, I will get a deduction. But you need to know, of course, there is no unlimited deduction that you get. So the limits last year over here were 15,000. He's increased it to 25,000. So we write down a limit of 25,000. But that is for aggregate of premiums for all of these people. So this plus this plus this, premium for you, premium for your spouse, and premium for your children. An extra premium you will get for your parents, you get another 25,000. However, if any of these people is a senior citizen, then this limit for that premium goes to 30,000. So for example, I said premium for self, he is 62 years and he is a resident, is, let's say, or let's first take a case where he is not a senior citizen. We say he is 56, spouse is 54, children are yet only 18 and 17. So the premium you paid is, let's say, 11,000. Let's say, okay, let's take another one. Let's say another 11,000, another 4,000, another 5,000. So all of this adds up to 22, 26, 31,000. But it will be limited to 25,000. So the deduction you will get is for 25,000. But if I say that this person becomes 62, he's a senior citizen and he is a resident, then what we will do is we will first apply the limit of 25,000 on these premiums. So that makes it 20,000 or 25,000, whichever is less. So we get 20,000. This premium is entitled to the extra 5,000. So we say another 11,000 we add. This becomes 31,000, or the maximum allowed is 30,000. So we get a deduction of 30,000. Just to make sure you understood this, suppose I take the premiums a little different and I say the premium for children are also 10,000 and 8,000. Then it becomes 29,000, which will be restricted first to 25,000. Then I will add the premium eligible for the extra 5, which makes it 36,000, but cannot be more than 30,000. Now, if none of these are senior citizens, then the limit becomes 25. But if either of the parents are senior citizens or both are senior citizens, then again the same rule, the limit goes to 30,000. Then there is something called central government health scheme, state government health schemes. Now, people from the Army, Air Force, they don't take health insurance because the central government looks after them. Similarly, for the railways employees, there's a central government health scheme. Now, these people have to make a certain contribution to the central government health scheme, and then when they are sick, the government will take care of all the expenses. But the problem is that it is not a medical insurance premium. It's a central government health scheme contribution. So that is also included in 80D, but within the overall limit of 25,000 or 30,000. And then comes the preventive health checkup. So, preventive health checkup, we just learned. You get your blood test done for thyroid, for maybe health problems, maybe any other test. Those preventive health checkups, and this, as I said, can be made in cash. So this can be allowed in cash. These cannot be allowed in cash. These have to be done by other than cash. But there is an overall limit here of maximum 5,000. So if I now take a case, I say he is 50, she is 48, and he is 10. There's a combined premium for them of, let's say, 21,000. And there's a preventive health checkup for him that he made for 4,500. Now what's going to happen is 21,000 plus 4,500 becomes 25,500. But there's the maximum of 25,000. Therefore, we can say that we've gotten only 4,000 from here, and deduction allowed is 25,000. Then for the parents, let's assume both are senior citizens and both are residents. We say there is 26,000 of premiums and health checkup of the father for another 4,000. Now 26 and 4 add up to 30 because these are senior citizens. The limit is 30. However, there is a overall limit of 5. Therefore, over here you cannot get more than 1. Therefore, 26 plus 1 makes it 27. Therefore, total deduction is 52,000. So I've given you a lot of questions on this. I'm sure you can go and do those. This is CA final level. This is a bit of understanding you will have from IPCC as well. One thing that has been amended by Finance Act 15 is that in cases of very senior citizens. So for a very senior citizen, the problem is people who cross the age of 80, insurance companies don't insure them. Medical insurance nahi milta beta. They feel you're about to go, so why should we insure you? The risk is high. So with the progress in medical science, you and me have seen that there are people around us who are 80 plus, people living longer lives, healthier lives. But of course, for people who cross 80, there is certain expenditure that is going to be incurred off and on. I want to get maybe my father insured if he's more than 80, but the insurance company does not do it. I incur an expenditure. The government doesn't give me a deduction because this deduction is not for expenditure. This is for treatment. No, this is for medical insurance. 80 GDP is only for specified ailments. So for normal treatments, I'm not getting a deduction. So from 15-16, if a very senior citizen has no medical insurance and you are not taken medical insurance, this is important, then the expenditure on the treatment of such a very senior citizen, expenditure on treatment of very senior citizen will be also covered within this overall limit. So that they've not given you a separate limit for it, but it is still covered within that limit of 30,000 rupees, which includes all of these. So this chart becomes very useful. There are examples given. In the notes, I've given you questions from ICAI module. Try and fit in those in this chart. I'm sure you'll be able to do well. So that finishes off our second category, which is the medical insurance. The other group we have is the group of donations. Now there has been no amendment here. Donations to a political party or electoral trust is allowed as a deduction. 80GGB is for donations made by a company. 80GGC is for donations made by a person other than a company. And the deduction allowed beta is 100%. But the donations must be made in a mode other than cash. If it's a donation by cash, it is not allowed as a deduction. Further, 80GGA. Now, when we were doing business and profession, we had talked about deductions of section 35. We talked about scientific research, donations. We talked about research for approved institutions, approved companies, national laboratories. Weighted deduction was given 1.75, 2 times, 1.25 times. But those deductions are only given to a person who has a business or profession. If a person does not have a business or profession, then the same donations covered there will be allowed, but over here it is only 100%. There is no weighted deduction given. This is a section 80GGA. There is a deduction of 35 AC, social and economic upliftment projects approved by the National Committee, and 35 CCA, which is donation to a rural development fund and a national urban poverty eradication fund. These donations are allowed again 100%. Now 80G is allowed for donations to approved associations. Just a quick discussion about 80G. But you will remember that 80GGA and 80G need to be paid other than cash if the donations are more than 10,000. Now, going to 80G, there's a list of donations given to us. We divide them into 4 categories. We have category A, institutions. Now you have Prime Minister's National Relief Fund. I am not going through the entire list. That list is given in the notes. You will go through those. There has been no amendment. There has been an amendment which I am going to be talking about here. So Prime Minister's National Relief Fund is covered. You have donations to educational institutes. You have donation to Armenia earthquake funds. You have donation to Gujarat earthquake funds. Donations for illness assistance funds, blood transfusion, to institutes running centers for autism, cerebral palsy, mental retardation, sports funds, cultural funds, army fund, air force fund, naval funds. But what is important to note is that there is a national children's fund. Now this is an amendment made last year, and you will remember these 3. As we said, let's do this smartly. If the examiner is going to ask a question, he's going to ask a question based on what have been the changes recently. So if 80G is asked, we need to remember National Children's Fund is covered now. Then there is a Swachh Bharat push. So Modi ji is passionate about cleanliness. So donations for the Swachh Bharat Fund to keep India clean are now covered by the A list, which means if you donate to this fund, you get 100% deduction. And for the drug abuse, so these 3 have been added this year, and you will remember these are covered by the A list. Now B list covered Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Trust, Rajiv Gandhi Foundation. Now all of these are, and of course there is a Prime Minister's Drought Relief Fund covered there. So these 4 you will remember from the Nehru Gandhi family. Jawaharlal Nehru ji ka Drought Relief Fund, Indira Gandhi ji, his daughter, and Rajiv Gandhi ji, his grandson. These 4 funds are covered by B list. In C list, you have donations to the government or a local authority, and they're going to be using this for promotion of family planning. And in the D list, you have donations to the government or local authority for a purpose other than family planning. Then there is a minority board. If you donate money to the minority board, it is covered here. If you donate money to housing societies which are engaged in development of cities, towns, villages, and we are talking about donation, not investment. Donation. Remember, donation does not give you a return. It only gives you mental satisfaction that you've donated for a good cause. Then, of course, there is renovation of historical and religious places like the Taj Mahal or the religious places, mandir, gurdwaras, masjid. So renovation, you are giving money for them. And then, of course, there is the last and the more important one is the charitable trust. We know that the income of the charitable trust is exempt under section 11. But a charitable trust whose income is exempt under section 11 needs to take 2 registrations. One is a registration under section 12 AA to get exemption from its income. The other is a registration under 80G so that anybody giving them donation can get a deduction of 80G. So this will cover the vast majority of your mandirs, gurdwaras, masjids, NGOs, non-government organizations, Red Cross, Mother Teresa, all these will be covered here. So this one is a residuary. Now, so we've divided them into 4 different lists. Why? In A list, if you donate 100 rupees, you get a deduction of 100 rupees. In B list, you donate 100 rupees, you get a deduction of 50 rupees. They're not going to give you the entire benefit of the deduction at times. In these 2 lists, there is a restriction. So you donate 100 here, you donate 100 here. the two will be subject to a maximum of 10% of your adjusted GTI, gross total income. And then the amount from the C list, which is covered here, will be 100% allowed, but the amount from the D list will be only 50% allowed. So just to make sure you've understood the calculation, we just do a small question here. For example, we say there is house property income. Let's keep writing. So we are calculating tax now. In this question, I said there is house property income of 2,50,000. There is salary income of 1 lakh. There is long-term capital gain of 30,000. As you can see, there is a special short-term capital gain of 1,20,000. We all know it is taxable at 15%. And of course, we have lottery, which is 40,000. So if I add this, so I get 5,40,000 as GTI. A few things we need to remember, that from the special income, there is no deduction allowed. So we need to be careful that the deductions can only be a maximum of 3,50,000. They cannot be up till 540. From here, I have a look. There are certain donations. There is a life insurance premium. I will give a deduction of 80C. There is a medical insurance premium. I will give a deduction of 80D. Interest on loan for own marriage. It's nice to get married. You might need a loan, but the income tax department will not give you a deduction. There is no deduction here. Then we go to the deduction for donations. Now, A list, we know the amount eligible will be 10,000. B list will be 3,500, 50%. For these two, there is a limit, so it will be 37,000 or 10% of adjusted GTI. Now, what he's trying to actually restrict, because the more the adjusted GTI, the higher the deduction can be claimed. So he wants to limit it to your regular income. Now, regular income is not these. So we say adjusted GTI will be GTI, which is 5,40,000. Less we will do 1,90,000, which means I get 3,50,000. There are two viewpoints I will share with you here. A viewpoint that says that lottery reduction has not been specifically mentioned under ATG, but there are judgments that will tell us that it has to be reduced. And logically, he is giving you or reducing special incomes. If he is reducing you these two, he will reduce this as well. And I am following that opinion that all three special incomes over here will be reduced. Reduce all other deductions that you are getting. You are already getting deductions of these. So these should not be a part of your. So I get 3,10,000 into 10%. So we said this or 31,000, whichever is less. So my approved amount from here is 31,000. Now out of 31,000, I will assume this 17,000 fully is covered because I'm going to get a deduction 100%. The balance 14,000 I will assume is from this, because this will be allowed 50%, which is 7,000. So my total deduction now comes to 10,000 plus 3,500 plus 17,000 plus 7,000. So 80G deduction I get is 37,500, and that I will subtract. So 462,500 becomes my total income. Now let's calculate tax on this. Now we know that in this total income we still have LTCG of 30,000, because special incomes, remember there was no deduction allowed from there. 111A I have is 1,20,000, and lottery I have is 40,000. The balance, remember, is my normal income. So 120 plus 30 plus 40 minus 462,500 is 272,500. Now let us assume this person is a senior citizen and is a resident. So the slab rate becomes 3 lakhs. So the entire normal income goes, and I have a balance of 27,500 in the slab, which we know can be set off from long-term capital gains. We've done this in the chapter of capital gains. So we get 2,500 overhead. Now 2,500 into 20% makes it 500. 1,20,000 into, again, 15% here is 18,000. And 40,000 into 30% is 12,000. So my tax beta is 30,500. But because the total income is less than 5 lakh, there is a rebate we know of 87A 2000. So I get 28,500 plus 3%, and that will be my final tax. So hopefully this bunch of deductions of donations should be clear. So moving on to the last category, children. ATE, ATGG, ATTTA and ATJJA, which I believe you can expect a question on ATJJA this time. Now ATE is for education. So ATE is for interest on education loan. So if a person takes a loan for his own education, the education of a spouse or any children, whether dependent or not, whatever is the interest that is paid, remember all deductions are allowed on paid basis, it will be allowed as a deduction. There is no limit for the interest. However, the deduction is for a maximum of 8 years. So if the education loan is for 3 years, you get a deduction for 3 years. But if the education loan is for 10 years, you get a deduction only for 8. The loan obviously must be taken from a bank, financial institution in India, but the education can be anywhere in the world. But you must have passed your senior secondary exams from any recognized board, recognized by the central, state government or local authority in India. So interest on education loan will be allowed as a deduction. That is ATE. Then ATGG is for rent for a house. So for a person who does not own a house and is residing in a rented accommodation, or maybe owns a house in a different city, is working in another city, so he's taken a house on rent. So that rent is allowed as a deduction. But if you and me have a small understanding of the rents today, even if you take a 1-bedroom or 2-bedroom accommodation anywhere in this country, it will cost you a minimum of 5 to 10,000 to 15 to 20,000, maybe even 30,000 per month, which actually means you could be spending anywhere between 1,20,000 to about 3,60,000. But the deduction given to you is a maximum of 24,000. So we will just remember, these limits do not make any sense. In fact, in the recent budget, Finance Minister Jaitley has increased this to 60,000, but for the moment, the maximum is 24,000. Then he says, you've taken accommodation on rent in that city, in the city of your residence. You, your spouse, and your minor child must not have any house. That means there should be no house registered in the name of you, your spouse, or your minor child. And if you have a house outside the city, it should not have been claimed as self-occupied. Because if you've already claimed a house as self-occupied, then why are you paying rent? So these are the conditions of ATGG. A person who gets HRA will get a deduction for the rent paid while computing the exemption for HRA. Therefore, ATGG benefit is not given to a person who gets HRA. Then ATTTA. Now ATTTA is for interest on savings account. So I'm going to make a chart for interest. I think this chart will be important for the attempt this time. So we now have interest on bank FDs. We now have interest on recurring deposits. We have on post office. Let's take this. So FD, bank FDs, recurring deposits. We have post office savings account, the savings account from banks, post office, and then we can look at interest on company deposits. First and foremost, all these interests are taxable. All of them are taxable. Only this is exempt up to 3,500. For a single account, for a joint account, the limit becomes 7,000. So this is exempt. So if you're getting interest of 5,000 from a post office savings account, only 1,500 will be taxable. Company deposit is fully taxable. We can also look at in cooperative banks. Bank FD will include cooperative banks. Now you have a deduction of 80 TTA, which is up to 10,000, but that deduction is only for savings account. So if I have a post office interest, let's say 5,000, and bank savings account interest of 7,000, what do? We first give exemption of 3,500, which makes it 1,500. 1,500 plus 7,000 makes it 8,500. So 8,500 becomes income from other sources included in the GTI, and we give a deduction of 80 TTA of 8,500 because it is up to 10,000. So that is one point that you should remember. The other is the point of TDS. Now till 14-15, TDS was deductible on bank interest, FD interest only, and the limit was 10,000 per branch. Because now banks are following CBS software, which integrates all the data of all the branches, therefore this has been removed and now it becomes bank. A recurring deposit has also been introduced for liability of TDS, and cooperative bank interest is also included. So now the TDS will be deductible on all these as well if the interest is more than 10,000 per bank, and the banks must be following CBS. If the bank is not following CBS, then it is still per branch. So that you must remember as part. Now 80 JJA. First of all, what is this for? Again, we are encouraging people in the manufacturing sector. Now in the manufacturing sector, you require labor. To encourage people to employ more people, more workmen, more labor. Remember, salary paid to labor, wages paid to labor will as it is be allowed as a deduction while computing business income. I hope you are understanding what I am saying. जब हम business income निकाल रहे हैं, at that point of time, the wages you are paying is an expenditure for the business. Therefore, obviously, it will be allowed as a deduction. Now, in addition to the deduction under Section 37, you get a deduction under 80 JJAA. So, for example, if I take it in very simple terms, if I employ 100 new workmen, and the word is workmen. In 14-15, you would have gotten no deduction, because that year, if you had employed more than 100, then only for the number in excess of 100, you would have gotten the deduction. From 15-16, that has been removed to 50. Over here, it was available only to a company which was engaged in manufacture. Now it is available to any person who's engaged in manufacture. So these very important changes to encourage a lot of people, firms, proprietary concerns, companies to get additional deductions by employing more than 50. So now what is going to happen? If a person employs 100, let's say at the rate of 4,000 per month. So while computing business income, we say 4,000 per month into 12 into 100 is allowed as a deduction under Section 37. That is one. Now, suppose this is happening in 15-16. In 15-16, for 50 workmen, in excess of 50, into 4,000 into 12, he will get an additional, the deduction is 30%. The deduction is 30%. And for these 50 workmen, he will get this deduction in 16-17 and 17-18 as well. So for 3 years, wages paid to these 50 who were employed in 15-16, you will get the deduction. Now in the year 16-17, let's say he employs another 100. Okay, let's change 100 over here. Let's say he employs another 70 new. Now in excess of 50 we have 20 here. Again we are assuming 4,000 into 12. This is the deduction he will get into 30%. And for these 20 he will get 16-17, 17-18 and 18-19. That in the very simple terms is the deduction of 80 JJAA. But there is one more condition that we need to look at, which is that the additional wages which are going to be paid, the number of regular workmen employed during the year, if it is less than 10% of the existing number of workmen in such factory as on the last day of the preceding year, then we will not treat the increase as any increase. So for example, I say in the first year you employed 100. In the second year you employed 55. Now the number of new workmen employed is more than 10%. But if I say you had 1,000 workmen and in the second year you employed, let's say 75, as on the last day you had 1,000, 10% is equal to 100. Now even if you've employed more than 50, but if you employed less than 10%, therefore you will not get deduction of 80 JJAA. Now one of the important points is that the number or the wordings new regular workmen, the word over here becomes important, regular workmen. Casual workers, contract labor and people employed for less than 300 days during the previous year are not eligible. These are not eligible. So let's just do a small question which was given in the ICAI amendment module to try and understand this in a simple manner. Now he says, Mr. A has commenced operations of manufacture of goods on 1/4/15, which is, that means 15-16 becomes the first year. And he employed 125 new workmen. Now new workmen does not mean regular workmen, so we have to find out, which included 15 casual, 15 workmen employed through contract labor, 25 regular workmen employed on 1/4/15, therefore they work for 365 days, 55 regular workmen employed on 1/5, which means they work for 30 days less, so that makes it 335. 15 regular workmen employed on 1/7, so they haven't worked for April, May, June, that makes it 92 days, so that goes below 300, so they are also not. So the new regular workmen we have is 50 plus 20, 70, 80. In excess of 50 we have is 30. Now those 30 over here into the number of the salary paid is 5,000 per month into the number of months, and we will get 30%. That will be your deduction under 80 JJAA. So let's just finish off with a question from the RTP, and this is the kind of question I believe can be asked in the papers as well. One he says is X Limited has commenced operations of manufacture of goods in a factory on 1/5/11. It had employed new regular workmen in its factory and the details are as below. So in 11-12, number of new regular workmen employed during that year were 300. But there are some workmen who leave. So by the end of the year, there were 300. In the next year, opening was 300. The 50 who left, sorry, he added 300. That is 300 plus 300 is 600. 50 left, so we have 550. No new workmen in the next year, but 20 left. No new workmen in 14-15, 30 left. So he has 500 as on 31st March 15. Why is the examiner giving me this data? For one, I believe we know the increase has to be more than 10%. The new regular workmen should be more than 10%. He says in 15-16, due to capacity addition, it employs the following workmen, including casual and workmen through contract. So let's go and have a look at that. He says casual workmen. Now please understand, in our counting of the new regular workmen, casual workmen are not included. So I'm not going to look at that. Workmen employed through contract labor, again I'm not looking at it. Now regular workmen, they must be employed for at least 300 days. So 1/5, okay, these are okay. 31/7, not okay. August, not okay. So in effect, he has employed only 55 for 80 JJAA. And since as on 31st March 15, the total number of workers were 500 into 10%, which is 50, he has employed more than 10%. So he is eligible for 80 JJAA, but please understand, the deduction is not restricted to 5. He will get a deduction for 55 workmen. And because it is 1st May, 11 months into, the wages available are 4,000. So let us multiply. I say 4,000 into 11 into 55, which is 24,20,000 into 30%. So 30%, which is 7,26,000, is the deduction he will get under 80 JJAA. He says compute the deduction, if any, under 80 JJAA available to X Limited. If the profits and gains derived from manufacturing the factory is 8.17 lakhs. Now that doesn't matter because we are not basing the deduction on the profits. Would the deduction under the said section be available if the details given above pertain to Mr. X instead of X Limited? So the answer given to you, as we just discussed, is that now the deduction is not restricted to companies alone. Therefore, Mr. X would be entitled to deduction since he satisfies the conditions mentioned hereunder. So that completes the amendments relating to deductions. For deductions based on investments. Now for deductions based on profit, what has been seen over the past is that the questions, if at all they've ever been asked, are based on case study. So in the next smaller topic, I'm going to be doing, when I do the case study for all the chapters, at that particular point of time, we'll take up the case study for 80IA and 80IB. So this is the amendments for deductions. Hope you understood them. Take care.